And good morning once again, options traders. Well, here's a really good question for the group. What is premium over parity? What does that mean, and why do professional traders always talk about premium over parity? Well, it makes things a whole lot simpler when you're trying to analyze trades. So let's go find out more about premium over parity and how it can help you make better decisions. Before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with a little background: intrinsic versus extrinsic values. Extrinsic values also being the time value. Let's say that the stock is trading for $100 and you look on your broker's platform and you find that the $95 call is trading for 7. Well, in this instance, you know that there is $5 of intrinsic value. That's the immediate benefit that's being conveyed in the option. And we know that because the way to kind of back into that and figure it out is that you have the right to pay $95 with the 95 call when the stock is trading for 100. Well, doesn't that seem like an advantage to be able to pay 95 instead of the current market price of 100? Well, yes. If the answer is yes, there's intrinsic value. Then ask yourself, how big is that advantage? Well, it's $5. And so that's where that $5 of intrinsic value is coming from. So the intrinsic value, we would also say, is the amount that it is in the money. So in this case, we are $5 in the money, and that's another way to figure out why we have $5 of intrinsic value. But there's an additional $2 in here. We just found out that there's $5 of intrinsic value, but the call is trading for 7. Well, that extra value is the extrinsic value. This is the additional value over the intrinsic value. So remember, the basic idea is that the intrinsic plus the extrinsic value equals the option's total premium. So in this instance, you have $5 of intrinsic value plus $2 of extrinsic value, and that in fact equals the option's total price, or the total premium. All right, so what is parity? Well, we've talked about this before. Parity is just a fancy word that really means equivalence. There's a lot of different parity conditions. There's put-call parity. We've talked about that many times. There's things like covered interest parity. There's all these different parity conditions in the markets. And what they're saying is that there's some type of a balancing relationship, some type of an equivalence in these formulas. So when we say that an option is trading at parity, it's implying that it's equal to something. Well, that something is stock. So if we find an option that is trading at parity, it simply means that you're equivalently buying the stock. And what causes the option to trade at parity is that it only has intrinsic value and no extrinsic value. Now, in the real world, there might be a few pennies of extrinsic value, but we would still call that trading at parity. Now, the two basic ways that you get an option to trade at parity is that you have to be in the money at expiration. And by expiration, I mean you're talking the final seconds. So even if you're in the money by only a few pennies, that option might be trading really close to parity. The second condition, the second way that we get an option to trade at parity, is if it's deep in the money prior to expiration. So yeah, we might have 30 days to expiration or 180 days. But if you push that call option deep enough in the money, you'll most likely be able to find one of those strikes that are trading at parity. So for example, let's say that the stock is trading for 100 and you look on your broker's platform and you find that the $80 call is trading for exactly 20 bucks. This option's trading at parity. And one of the ways we can figure that out is to say that if you were to use your option, if you were to exercise it and buy the shares, you would pay the strike. That's what you pay upon exercising. You would pay the $80 exercise price, but you paid 20 bucks to buy the call. So there's a $20 cost. And if you add these two together, it comes up to 100 bucks, which is in fact exactly the price of the stock. So in this case, we would say the option is equivalent to buying stock. You could either buy the stock at 100 or you could pay 20 bucks for the $80 call, and they're just two different ways of doing the same thing. In both cases, you are paying 100 bucks if you were to exercise this call, to get 100 shares of stock. Both of them cost $100, so the $80 call would be trading at parity. So let's see what parity looks like on a risk graph. So here's a $100 call. Now I'm going to use a cheaper call just because it'll be easier to show the parity conditions. But the current curve is going to look like this in red. Now notice that we don't have to go all that deep in the money to find where this red curve starts overlapping the black. That's a real good visual to find out where the option is trading at parity. We really can't see a significant difference between the red line and the black. They're overlapping each other. So take your pick. Buy the call, buy the stock. You're effectively doing the same thing. So up in here where the red and black lines overlap is where we would say the option would be trading at parity. Now down in this region you can see that there is a gap between the red and black lines. And this little gap right here is the extrinsic value, the option's time premium. And so this set of strikes in here, let's call it the 95, 100, and 105, are definitely not trading at parity. They still have a pretty good bit of extrinsic value available on them. But you can also see that as time goes by and this red line sinks closer to the black, more and more of these areas up into here are going to match, where this red and black line will eventually overlap. So when you get right to expiration, that red line becomes the black line. And that's why you can also find an option trading at parity, even though the option might only be a few pennies in the money. But if you've got 10 seconds till expiration, you can be sure it's trading at parity. So now you can see why when you get up into this range where the red and black lines overlap, let's say if the stock is up here at 110, what's the $100 call trading for? You know, it's trading for $10. It's trading at parity. The stock is 110. If you pay 10 for the 100 call and were to exercise it, your cost would also be 110. What if the stock is up here at 115? Well, now you know that the $100 call must be trading for $15. No more and no less. It's trading at parity. All right, so now with that little background out of the way, the big question is, what is premium over parity, and why is that important? Well, remember, the premium over parity is the extrinsic value. That's really what we're saying, is how much additional value is there over and above the parity condition. That's just another way of saying how much extrinsic value or time value is there. So if we have the stock trading at 100, let's say that the $95 call is trading for 7. Well, as we found out before, there's $5 of intrinsic value, but now we have an extra $2 because the option is not trading for 5, it's trading for 7. There's $2 of extrinsic value. So professional traders, when they're looking at this option, a lot of times they'll just say, I bought the option at 2 over. And that's just a short version of saying, I paid $2 of time value. If the stock is 100 and I bought the 95 call, you should immediately know it's got to trade for at least $5. So that's not even remotely interesting. We know that. What's interesting is how much did you pay over and above the intrinsic value. All right, so that's what we're talking about when we mean premium over parity. But the big question is, why is this important? What can you gain by looking at things in terms of premium over parity? Well, let's do some examples. Let's take a look at the covered call. Let's say the stock is 100 and you sell the at the money $100 call for $4. And now the stock rises to 110. And you decide that you don't want to be short this call anymore, so you buy the $100 call back and it's trading for 11. Did you lose money? Now, most traders say, well, of course I lost money, because they're just looking at one part of the trade. They'll say, I sold the call for 4 and I bought it back for 11. Oh, I just lost my shirt. I got my head handed to me. I really took a big loss. Well, see, it's easy to fall into these traps when you're trying to break down multiple positions at different prices. So then if they want to get fancy, they'll say, well, let's check the details. Well, for the stock, let's see, I paid $100, so we'll use a minus sign. I spent $100. I sold the call for 4. I collected 4. That's a net cost of 96. Now the stock is 110. If I buy the $100 call to close, I spent 11. So my net cost is now 107, and that's because I've effectively spent 96 plus another 11 bucks. So I'm out $107, but the stock is trading at 110. Hey, it looks like a net gain of 3. I didn't do so bad after all. But watch how much easier it is if you understand premium over parity. When you sold the $100 call, it was at the money, you sold it for 4 bucks. And when you bought the call to close, you spent 11. Now again, that's the way that most traders look at it and they say, I therefore lost. But watch what happens when we look at things in terms of parity. You sold it here, it was at the money, so that is $4 over parity. And when you bought the $100 call to close, the stock was 110. We know the option's got to trade for at least 10, but it's trading for 11. So you actually bought it for $1 over parity. So look how simple it is. I sold it for 4 over, I bought it back for 1 over, that's a net gain of 3. See, I don't need to look at all of these intermediate steps. I can immediately tell just by looking at premium over parity that I have a $3 gain. Let's take a look at a second example with a covered call. Let's say the stock is 102, you spend 102 for the stock, you sell the $100 call for 7. Now you're selling it in the money. It's 2 bucks in the money, but you're collecting 7. The stock rises to 115, you buy the $100 call to close for 16 bucks, and the question is, did you gain or lose money? Well, let's use premium over parity. When you sold the $100 call, it is $5 over parity, and when you bought it back, remember the stock's trading at 115, options got to trade for at least 15, you bought it back for 1 over. So if you sold for 5 and paid 1, that's a net gain of 4. So we know that you have a net gain of 4. I don't need to go through all of the steps and find out how much I made or lost on the stock and how much I made or lost on the option and try to figure it out. It's instantly apparent once you look at things in terms of parity. Let's try a couple more. Let's look at a vertical spread, a debit spread. Let's say our stock is 100, you buy the $95 call for 6, you sell the $100 call and collect 4. So this spread has a net debit of 2. Well, here's another question. Does this vertical spread have negative theta? And most people would say, well, yes, because it's a debit spread. Well, not necessarily. It depends on the premium over parity. So here we sold this for $4 over parity. That was an at-the-money call. But when we bought this one, we bought it for $1 over. So remember, the $95 call is 5 points in the money, but you only spent 6. So you paid $1 over parity. So now take a look at it. If you sold for $4 over parity and paid $1 over parity, on a net basis, you have a $3 extrinsic value in your favor. So no, it doesn't have negative theta, even though it's a debit spread. You have positive theta. And it's instantly apparent because you sold more extrinsic value than you paid. And so here's what it looks like graphically. With the stock up here at 102, you're going to find that the current curve in red is going to move up. Now see, if the stock is down here, yes, you have negative theta. But on this side, you've got positive. So I could instantly tell that just by checking premium over parity. Now let's look at another trap that traders fall into, the credit spread. I'll say, well, the reason I like credit spreads is because I have positive theta. Well, let's see if that's true. Stock is 100, you buy the $100 call for 3, you sell the $95 call for 6. That's a credit spread. You're selling the lower strike call. Got to be worth more money. It's a credit spread. I have a net credit of 3. So if I've got a credit of 3, this has to be positive theta, right? Well, check premium over parity. You sold here for $1 over parity, and when you bought the $100 call, you bought it for $3 over parity. So what's your net here? The net is you have paid more extrinsic value than you received. So you must have negative theta. And again, that's because you have purchased more extrinsic value than you sold. So graphically, this is what this vertical spread looks like, the 95-100 call spread that has been sold. See, it looks like positive theta, and that would be true if you were in this region, but remember the stock is up here at 100. So this red line is going to move down. So we have negative theta even though it's a credit spread. But do you see how easy it is to get to the answer without stepping through all of the individual trades? Just look at premium over parity and you can find the answer immediately. So premium over parity. When analyzing positions, don't worry about net debits or credits. Focus on premium over parity and the answers become instantly clear. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.